Welcome to the debate. Today we are looking at Embecta, ticker EMBC, which is a pure-play diabetes consumables company that was spun out of Becton Dickinson back in April 2022, page 1.
Right, a classic spin-off scenario.
Exactly. And we're working strictly off a comprehensive financial close-read report and some machine learning screening data today. The core question we have to resolve for the investment committee is Embecta a deeply undervalued cash-generating compounder with a massive margin of safety, or is it a structurally distressed value trap masking its secular decline through aggressive cost-cutting and incredibly opaque disclosure?
And just as a quick disclaimer before we get into the weeds, we are analyzing the interpretation of the stock pitch results here. We aren't making buy or sell recommendations or giving financial advice.
Right, no financial advice. So in this IC format, I'll be taking the intrinsic value and cash generation thesis, arguing why the bullish pitch works.
And I'll take the forensic risk, credit, and structural distress side, basically arguing why the pitch fails based on the data artifacts and the terminal risks.
Perfect. So let me lay out the pitch claims and the bull case first. The crux of the bullish thesis is that Embecta is severely mispriced by the market. Spin-offs are notoriously messy, right? Parent companies shed slower growth assets, load them up with debt, and leave them to figure out their own standalone infrastructure. That transition creates a ton of accounting noise. But if we cut through that noise and look at the Penman residual income model from our materials, which calculates intrinsic value focusing on earnings over book value, it calculates an intrinsic value for Embecta of $3,325 million, page 4.
Against a market cap of what, about $750?
Under $750 million, yeah, $744 million to be exact. So we are looking at a 347% margin of safety. And the primary driver here is the cash. This is an asset-light business that has seen a massive free cash flow recovery to $216 million over the trailing 12 months.
Assuming we can trust that free cash flow calculation.
Well, that cash recovery actually resolved a temporary screening veto in our system, bringing their net debt to free cash flow ratio down from a flagged 6.05 times to a much safer 5.37 times. Furthermore, the company has a grade A durability score sitting in the 99.2nd percentile. You have a 30% free cash flow yield on a business with sticky, recurring medical consumable revenues, pen needles, syringes. The market is just being wildly too punitive here.
Look, I hear the pitch, but you can cite a 20% free cash flow margin and a 30% yield all day long. We both know how they actually got those numbers, and it wasn't through operational excellence.
It was through cost rationalization.
It was through starvation. They slashed research and development from a run rate of around $22 to $24 million down to just $4 to $5 million per quarter. That's not sustainable margin expansion. That is burning the furniture to keep the house warm.
I mean, R&D cuts in a spin-off are pretty standard.
Not cuts this deep. Let me lay out the bear case, because the forensic evidence here is alarming. Our machine learning distressed model, which has an AUC, an accuracy rating of 0.807, independently rejects Embecta. It places the company in the high distress tier for both fiscal year 2023 and 2024.
But that model is looking at historicals before the recent recovery.
Is looking at severe debt-to-equity levels and structurally pressured free cash flow margins before management engineered this artificial recovery. You're pointing to an algorithm that sees trailing cash flow, but you have to pair that with the reality of a $1.35 billion debt wall, page 18, and a structurally declining market.
The GLP-1 headline risk.
It's not just a headline risk. GLP-1 drugs are displacing the need for the manual insulin injections that Embecta relies on. And to make matters worse, they have an abysmal management candor score of 3 out of 10, page 18. They are actively obscuring the deterioration of the business.
Okay, let's move into cross-examination, because we need to pressure test these claims. I'll let you start. Hit me with your hardest forensic questions.
Gladly. First question, you cited a 30% free cash flow yield, but how do you reconcile the Morningstar's $2 million CapEx figure with CompuStack's $23.6 million from the prior year, P21? If one data feed is missing over $20 million of necessary reinvestment, isn't your 30% yield practically unverifiable?
That is a known data anomaly, yes. But even if we normalize the CapEx and impute a $25 million annual reinvestment rate, Adjusting for that discrepancy, the free cash flow yield remains well over 20%, P21. The absolute math is still incredibly robust. My turn. You frame the leverage as an existential threat, but isn't the balance sheet manageable when you consider their interest coverage troughed at 1.5 times in fiscal 24, but safely recovered to 2.6 times trailing 12 months?
Manageable? Okay, question 2. How can you trust that trailing recovery when there is a 12.5 percentage point operating margin gap between fiscal 24 and trailing 12 months? That gap implies roughly $130 million in unconfirmed one-time charges P22. The earnings quality is practically non-existent.
The earnings quality is noisy because of the transition. Question 2 for you. You are hyper-focused on terminal decline, but doesn't the intrinsic value of over $3 billion hold up even if we assume a base case of absolutely zero growth in perpetuity P6? The 7.2 times trailing PE is an extreme discount that compensates for the volume risks, P6.
Question 3 then. How can you confidently assume zero growth is the floor when gross margins have already structurally compressed 870 basis points from 71.4% to 62.6% since the spinoff, P14? That's not a temporary blip. That's a structural reset.
But they maintain a strong gross margin of 68.8% relative to their distressed peers, page 22. My third question. You are claiming management is hiding terminal decline. But isn't their regulatory disclosure consistently above median, actually sitting at the first percentile, showing high competence and transparency where it legally matters most for a medical device company, P20?
Competence in generic FDA filings doesn't pay down debt. Question 4. Speaking of opacity, Embecta's 2025 10K produced 0 extractable claims, and their capital allocation disclosure sits at the 0th percentile, P19. How do you underwrite a company that refuses to provide a narrative on debt repayment sequencing when they owe $1.35 billion, P18?
I concede the capital allocation NLP scores are poor, but again, I see that as an artifact of transition service agreements, or TSAs, rather than fraud. Question 4 for you. If the debt wall is so terrifying, aren't you ignoring the fact that they are sitting on $201 million in cash right now, page 25? Doesn't that provide an adequate near-term liquidity buffer against any immediate shocks?
Cash burns fast when you can't refinance. Question 5. How do they organically deleverage when the critical 2027 credit facility cliff is only 12 to 18 months away, page 28? Paying down the massive 2030 bullet organically would take 6.3 years of their total free cash flow, page 28. They are entirely dependent on capital markets while their core business shrinks.
The debt markets are routinely open to companies with strong recurring cash flows. Question 5 for you. You criticize the algorithmic screening as a mirage, but the system correctly assigned it a Track 1 compounder status because of its sheer cash generation, page 22. Are you saying the algorithm is entirely broken?
Yes, and that leads to question 6. The materials explicitly point out glaring internal contradictions in the data. That Track 1 assignment occurred despite a hard veto rejection and a durability bin assignment of none, page 22. The report itself calls this an internal contradiction requiring reconciliation. Why are you ignoring the veto?
I'm not ignoring it. The massive FCF recovery resolved the veto page, Unc 5. Final question for you, question 6. You're treating the R&D cut as a deliberate starvation of the product pipeline, but isn't cutting bloated legacy R&D from a massive conglomerate down to a normalized standalone rate a highly rational capital allocation decision, page 15?
It's rational if you're trying to dress up the bride for a quick sale, but not if you're trying to survive a secular shift. Look, they had connected pen initiatives, smart devices to help insulin users track dosing, that were supposed to be their defense against GLP-1s. Cutting that artificially inflates current margins. Without that cut, the veto flag on their net debt to free cash flow would still be triggered.
If those connected pen projects were burning cash without a clear path to commercial viability, cutting them was exactly what management needed to do. We have to separate ugly corporate optics from fundamental unit economics.
Okay, let's force precision here. Let's do the scenario framing. Let's run the bull, base, and bear scenarios based on explicit assumptions in the sources. I'll start with the bear scenario.
Go ahead.
Bear scenario, assumption 1. The 870 basis point gross margin compression, page 14, is permanent and worsens as GLP-1 penetration accelerates. Assumption 2. Credit markets tighten, and they hit the 2027 credit facility cliff, page 28, and are forced into punitive interest rates. Operationally, revenues decline from the current $1.1 billion range, page 14, down to $900 million. We would need to see the next few quarters of volume attrition metrics to confirm this. But currently, management's disclosure on volume attrition is at the first percentile, so we are flying bland, page 14.
That is a grim scenario. Here is the bear scenario. Assumption 1. The GLP-1 displacement is real but gradual, meaning revenues remain essentially flat at that $1.1 billion mark, page 14. Assumption 2. The $2 million Morningstar CapEx is wrong, and we normalize it to $25 million, page 21. Operationally, they maintain that 20% free cash flow margin, page 7, through aggressive cost control. They refinance the 2027 debt at slightly higher rates, but the $201 million cash buffer absorbs the shock, page 25. To confirm this, we need the upcoming 10Q to show stable gross margins around 68.8%, page 22.
And what does the absolute bull scenario look like to you?
Bull scenario. Assumption 1. The market has widely overreacted to GLP-1s, and the global installed base of intensive insulin users remains sticky. Assumption 2. The R&D cuts to 4 to 5 million a quarter, page 15, successfully eliminated stranded overhead without damaging core sales. Operationally, the $130 million in unconfirmed one-time charges roll off, page 22, proving they were just temporary transition service agreement costs. They generate over $220 million in clean FCF, easily refinancing the $1.35 billion debt wall, page 18. We need to see the causal density in their filings improve from that 82% drop, page 19, proving management is finally gaining visibility into their standalone structure.
Okay, fair enough. You steel man to the case.
So what would actually change your mind? What are 3 falsifiable triggers that would make you abandon the bear thesis?
I love this question. Okay, 3 triggers. First, if we get a clean data reconciliation on the CapEx. If management explicitly files an updated CapEx schedule that aligns with CompuStat and still proves a double-digit free cash flow yield. Second, if the capital allocation NLP score improves from the 0th percentile, page 19, and management actually outlines a sequential deleveraging plan for the 2027 and 2030 debt, page 28. And third, if they actually disclose volume and pricing dynamics regarding the GLP-1 impact, proving the core business isn't bleeding out. If those 3 things happen, I will concede it's a value play. What about you?
Good triggers for me to abandon the bull thesis. First, if that 2.6 times trailing interest coverage ratio, page 24, slips back below 2.0. That would indicate the debt is suffocating the cash flow. Second, if we see the gross margin compress another 200 basis points from the current 62.6% level, page 14, that would prove your structural pricing power loss argument. And third, if the $130 million in operating margin gap, page 22, turns out to be permanent structural costs rather than temporary TSA roll-offs, if those happen, I agree, it's a value trap.
It really all comes down to the 2027 credit facility maturity. That is the ultimate proving ground. If algorithmic screening just looks at trailing margins and flags a compounder while ignoring a 0 percentile capital allocation disclosure, page 19, it's a recipe for catching a falling knife.
But if the raw cash generation holds up, the absolute math of a 347% margin of safety, page 4, will completely vindicate the quantitative model. I think we've established some solid common ground here. We both agree the upcoming 2027 maturity is the catalyst, and we've identified massive investigation gaps, specifically the CapEx discrepancy, page 21, and the opaque transition service agreement costs, page 22.
We definitely need the next round of diligence to focus heavily on reconciling those data artifacts.
Absolutely. We have to weigh the raw mathematical upside against the structural and forensic risks buried in the text. There's a lot more to explore in these materials, but we'll leave it there for today. Thank you for joining us on The Debate.